All right, guys. I wanted to do some problems where it's like the overstated, understated type problems. This will help you on the test also. And then I think there was one depreciation problem that I'm going to show you real quick too. So this will just kind of help prepare you for the test a little more. All right, so on the study guide, at least one of the study guides, there's at least one problem for this, and I'm going to make some adjustments to it to show you different variations that you can see. Okay, so the accountant for Belden Jewelry Repair Services forgot to make an adjusting entry for depreciation expense for the current year. Okay, so that adjusting entry would be debit. Oops, that's not right. Debit depreciation expense, and then credit accumulated depreciation, right? And it doesn't tell us the amount, but basically that's what it would be. So think about this. So this is a EDLLRC. So basically we're recording an expense, which is reducing equity, right? And then we're also recording this here is a contra asset. So we're reducing the assets. So if you look at this, liabilities plus equity, we're reducing our balance of our assets and we're reducing the balance of our equity, right? Because expenses reduce equity. It's one of the two things that reduce equity. And then when we credit an asset account like that, then we're reducing the assets, okay? So that's the idea. So if we didn't do so the idea behind this is if we failed to do this, if we forgot to do it, then we didn't record an expense and we also didn't reduce our assets down, okay? And so, so we're looking for something like expenses are understated, right? Because we didn't record an expense. That would be one possible thing, understated, not written very well, okay? Or assets would be overstated, right? Or because this accumulated depreciation would reduce down the assets. Or another thing that could be is net income would be overstated, right? Because remember, net income is simply revenue minus expenses equals net income, okay? And so if we didn't record an expense here, then our net income would be overstated, okay? So I like to go through the possibilities. I definitely like to do the journal entry before I start looking at the answers, because the answers can screw you up, okay? So total assets are understated. No, opposite, right? Assets would be overstated. Okay, so this can't be it. Revenues are overstated. No, this doesn't have anything to do with revenue, right? This has to do with expenses and assets. So that can't be it. Total assets are overstated. Yeah, it can be that one for sure. Let's look at the next one. Net income is understated. Okay, so it can't be that one. So this has got to be overstated. So it's not that one. So it's definitely total assets are overstated, right? Because we didn't reduce down our asset account with this adjusting entry. See, these can be a little bit challenging, okay? So if we forgot to do an adjusting entry for depreciation expense, our expenses would be understated, right? Because we didn't record an expense. Our assets would be overstated because we didn't record this credit, or net income would be overstated because net income is simply the result of revenue minus expenses, okay? So that's the one that it gives us, that's one problem that it gives us here, okay? Let's do another one. Sorry, trying to get this all erased. Okay, try and get all this erased. And I'll do some other ones to kind of help you. So, so any of them, if it says they failed to make an adjusting entry for any kind of expense, so like, let's say we failed to make an adjusting entry for salaries expense. Okay, so instead of depreciation expense, let's go salaries expense. Okay, so that adjusting entry would be debit salaries expense, and then credit salaries payables. So the key, I guess the first key to these ones is you have to know what the adjusting entry is. So if they failed to make this adjusting entry here, you have to know how to make that adjusting entry. So salaries expense, salaries payable. Okay. Then you have to think through and say, okay, if they didn't do this, then again, expenses would be understated because we didn't record the expense. Liabilities, right? This is a liability account here. That would be understated. Okay. Net income, overstated. I don't know. That's the main things. So expenses would be understated because we didn't record the expense. Liabilities would be understated because we didn't record this liability. And then net income would be overstated. Okay, so that would be another example of one they could do. I mean, it could be for any adjusting entry. Like here, let's do this. I'm gonna scroll up to these. Okay, so like, let's just go to if we failed to do. So if we failed to do the adjusting entry for, well, we could do one of these. We just did depreciation. This vacation pay one, this one would be like salaries expense. Okay, like this rent one. So if we failed to do the adjusting entry, this one here, number 2. So if we failed to do the adjusting entry for rent, okay, that we used up rent. So just think about it. What the adjusting entry is going to be rent expense and prepaid rent, right? Okay. So expenses would be understated. There's an asset account here. So assets would be overstated. Okay. Net income would be overstated. Okay. Because we didn't record an expense. So that's the idea there. Let me see if there are any others here I want to do. Make sure. Just make sure that we got them. Oh, sorry. So we did depreciation. Oh, we got that one. Okay. I think that's all right for understated, overstated ones. Okay. So the only other thing I wanted to do. Okay. So imagine on this one here, this number 7. Okay. I want to draw. There we go. Okay. Okay. So this one here, well, we bought this equipment, $10,200, 5 years. They use the straight line method, calculation depreciation for every month. The book value of this equipment is shown in the balance sheet date. It will be, okay. So this is asking for the book value. I think there might be a problem like that on the test. But if it's just asking for what the depreciation expense is, then all like per month, and if it lists a whole bunch of different pieces of equipment, just do that for each piece of equipment. Okay. So per month, this is going to be, so it's $10,200. So just go 10,200 divided by 12. That'll give you, what does it have? And no residual value. Okay, yeah. So if it has no residual value, then just divide that by 12. That'll give you your monthly depreciation. Okay. Let me make sure on the test problem. 10,000 divided by 12. So anyways, that would be $850 per month. Let me look and see on the test. Yeah, yeah. So anyways, if it, so let's just say it had this piece of equipment that was 10 years, 5-year useful life. Let's say it had another one that's $5,000 was the cost, and its useful life was 12 years. Then you just go 5,000 divided by 12. Timeout. No, timeout. I screwed this up. Start over here. Okay, so 10,200. Its useful life is 5 years. That gets the annual depreciation. Sorry, I screwed this up. Okay, so 10,200 divided by 5. That gives us our annual to 2,040. Okay, all right. 10,200 divided by 5. Okay, that gives us our annual depreciation, but then we need to get our monthly depreciation. So 20,040 divided by 12. So now we get 170 per month. Okay. And so then this one, let's just pretend it's $5,000 is what it cost us as a 12-year useful. I don't know what I ended up saying on that. We'll just say 12-year useful life. So 5,000 divided by 12. That gives us kind of a goofy number, 416.67. There's a dead spot on this screen. Okay, 416.67, and then you would divide that by 12 again to get the monthly. 12, that gives you 34.72. So that gives you 34.72. Okay, and then you would just add all of those up to get the amount of depreciation expense per month for the company. Okay. Hopefully that helps. Hopefully those understated, overstated problems are doable for you. Let me know if you have questions on them. Okay. Thank you for watching.